listener is ever left behind.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us each and every week, bringing you information about what's happening in the mortgage and real estate markets, both here locally in the KCAA listening area, which is the Inland Empire, i.e. some parts of LA, some parts of Orange County, a little Inyo, a little Palm Springs. And it also brings you interesting news about what's going on nationally as well as locally. So all these things together bring us to you on a weekly basis, Saturday and Sunday, actually, and I really appreciate you listening. We are on KCAA, as I said, those people in that radio station. Thank you very much for bringing us to them, to you. And thank you very much also for feedback that we get on the show about some of the topics that we're talking about on a daily. Rates are always the number one thing that we talk about on the show. Why? Because it instantly affects what you can afford to buy. Now, there's some interesting statistics out there. I'm going to just quote a few of them. Let's see. Housing affordability. 90% of all buyers cannot afford half the homes for sale. 90% of the buyers cannot afford half the homes for sale. So naturally you're thinking, well, that means that the other half, probably 90%, can afford. No, that does not mean that. The number is 13% can afford those homes that the half the people in the 90% bracket can't afford. This means that the affordability index, what we call can you buy it or can you not buy it, is really in a rough shape. Some of the things that bear that out are how prices are still rising. That's incredible. Now, we've had a downturn both in the housing market just based on real estate interest rates and how those interest rates are affecting buyers and their buyers' intent to buy. Given that what it is, you would think that we would see falling real estate prices, and we see falling real estate prices in certain markets. However, year over year, and this is January 2023, we've seen, where is the number? It's here somewhere. Okay. We see housing prices go up 7.5% year over year. So a year ago, January, they have come up 7% since then. Now that means simply that we are still in an increasing equity market in your home, which is when people talk about inflation, when they talk about recession, when we talk about the things that make people stay up at night and try to figure out what they can do about wanting to get that new house, you don't have to if you already own your house, because the amount that you owe is constant, but the amount of equity you have in the house is still rising. This is unprecedented, probably 5 years in a row, maybe even more. Maybe more like 35 to 45%. The equity you currently have in your home, you've received over the last, as I said, 3 to 5 years. It's incredible. It's still happening. So we've got the Fed, 25 basis points. Well, we've been waiting, and those of us in the mortgage market wait for numbers to happen in order to show buyers, hey, get out there and buy. We've seen applications up in January. That's a good thing, purchase applications. Now, in some markets, not as great as others. But let's just talk about the Inland Empire. Let's talk about San Bernardino and Riverside counties. Those counties are still holding their own, still see prices increasing, and still see a record low inventory, although we have seen nationally the inventory on housing continue to build, albeit slow. Now, last week we talked about 1.5 million houses that were finished and sold off last year. That's a big number, 1.5 million. We could do that 10 years in a row and still have housing shortages in the inventory that we're looking to have people buy. We always look to new homes for that particular number. New homes, as we talked about again last week, new home sales are down. New home starts are down. The big builders are waiting for whether the inflation is going to overtake the economy, i.e. the Fed raising the short-term interest rates. Although they didn't raise it 50 basis points, they raised it 25 basis points, which everybody had been anticipating. But until you see and hear it, well, yeah, that's what you're thinking about. You're thinking about how it's going to affect the market. How's it going to affect sellers? Can I afford the house based on what I'm making today if we have the Fed keep raising interest rates, which means that the banks are going to raise my credit card, they're going to raise my car loan, they're going to raise my short-term interest rate, and if you've got student debt, guess what? That's probably going to go up as well, although student debt is sometimes excluded from the calculations of the debt you owe. You need to check with the lender, and you need to check with your particular program with that lender to make sure that that is in fact true. Okay, I wanted to get into a couple of things, but first, if you've had a medical emergency in your family, could affect your credit adversely. If you've had death in the family, if you've had a sudden loss in income, a lot of things that affect people, not only psychologically, but financially, weighs heavily on anybody. I mean, whether it's myself, whether it's you. If you're out there and you're in that kind of situation and you're looking for some kind of relief on your mortgage, if you're looking for somebody to help you out in the mortgage payment, go back to your lender. Go back to the person who gave you the loan to begin with. There are many programs that you can get into which can extend out your debt and do some bit of debt forgiveness at the beginning of your loan. What do I mean by that? Say you're in a 30-year fixed rate loan at 3%, lost a job, can't pay your mortgage. You're looking forward to getting a new job, but you haven't quite gotten it yet, and you're 2, maybe 3 months behind on your rent, on your mortgage. You can go to your lender and say, look, here's the situation before I get into a non-payment situation and a foreclosure situation. I want to extend out my loan 40 years. I'm going to get a job. It's going to start this month. I know I'm behind. Can you give me a 40-year interest-only loan to get the lowest payment until I can catch up? And then we'll go into a different kind of loan scenario. Or just maintain that 40-year. The answer is that is a good plan. The lender would probably go for it. The reason is that all lenders want to keep you in your home. They don't want your home. They don't want anything to do with foreclosure. The laws surrounding that, not only that, but the lost revenue and obviously the most important thing, displacing you as the homeowner out of your home, is not anything anybody in the lending industry wants to do. Fannie Mae and Freddie Mac have developed programs to be able to keep you in your home. Excuse me. And that is exactly what I'm suggesting here. So if you're in that situation, this is what you do. You can always call. And the other thing, too, is if you're in a situation where you've got any of those things that I mentioned happening in your life, you really need a professional to talk to who you can trust. Obviously, the people who I work for, the Malibu Funding crowd, they're great. And they're able to really think and help you think through your particular situation to the best of your advantage. And the main thing here is to keep you in your home. Now, the reason I bring all this up is because people are talking recession. Now, I think, as I said last week, we probably will get a slight recession in Q3. We look at Q1 now. We're in the middle, towards the end of January. It looks as if last year's GDP numbers are 2.9%, and that January this year, the economy looks okay. Stock market is happening. Now, stock market is forward-leaning, so if you see the market uptick or basically go up in value, it usually looks at 6 to 9 months down the line, thinking, okay, at that time we'll probably be doing fairly well. And that's a forward indicator. There are backward indicators, of course, but when looking at your decisions and what you need to do to make a decision, whether you're going to refi that house or really purchase, you really need to talk to a professional. A good professional who has your best interests at heart, who can lay out several different programs, several different things, several different ways by which you can take advantage of whatever your situation is, or give you the best option if you're in a no-win kind of end-of-your-rope scenario. These are all things that most loan officers will do for you. Certainly the company that I work for, Malibu Funding, 79620, that's their NMLS number. You can always go to them. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. We bring to you not only information, but we hopefully bring you a perspective about the sentiment, about what we feel, what's happening in the marketplace. Because believe it or not, it's not a cold, hard number thing. A lot of times people are interested in, whether it's a good time to buy. How many times have you heard it out there? Is this a good time to buy? Is this the best rate you can give me? It's all how you feel about it. So in order to deliver the news, whether it is a good time to buy or not a good time to buy, we usually look to information and people to deliver that information. So with us once again is our in-house expert on all of this is Charles Giscombe, who works for Malibu Funding, who produces and pays for the show. Chuck, how are you?
Jeff, thanks for having me again, man. How you doing?
I'm okay, man. Thank you very much. And thanks again for coming on the show. I really appreciate it.
Not worried.
Okay, so let's talk a little bit. Let's talk about affordability. I spent some time in the previous segment. How are people affording what they're affording? We talked about how half the buyers out there can't afford 90% of the homes. So how is it that we can increase affordability, especially for first-time home buyers, people that want to get in there and buy their home?
Well, you know what, Jeff? Interesting question. Obviously, there's a traditional route of loans that we could take, which will allow the least amount of a down payment. So, for example, on a conventional loan, you can put 3% down. On a FHA loan or a government loan, you can put down 3.5%. Right, and
yep.
Obviously, obviously that will get you in. A lot of that is afforded to first-time home buyers. There's also down payment assistance programs and grants that can be given to individuals if they're first-time home buyers by certain banks. There's an initiative, there's a minority program, there's different programs that will allow people to come in, if they don't have the down payment, to still have the ability to put down payment down that's gifted to them or granted to them, and at the end of the day, they'll still be able to qualify for a loan if they have the other documentation that's required for them to financially qualify for a loan. So there's many different ways to get into a loan with a low down payment. There's also VA loans. VA loans a lot of times are
right.
dollar down loans, which is no down payment loans for individuals that have served our countries. For those that have served our country, we appreciate your service. Thank you very much. Malibu Funding does not take that for granted, and we appreciate you a great deal. So those are those type of loans that will allow those individuals to get into loans as well. Many different loans like that are available, USDA loans, certain loans. On the front of individuals who may not qualify for those particular loans, there's also low down payment loans, not low, or 10% or 5% down for individuals that are providing bank statements, that are entrepreneurs, that don't have their tax returns, but they still can qualify for a lower down payment loan and still decent competitive interest rates that will allow them to have opportunity to afford the house, as well as terms for 40 years instead of 30 years. That
right.
might make the monthly payment lower for them, Jeff, to make that monthly check that they write every month a little bit lower, allowing them to qualify or to afford the home that they're in currently.
That 40-year loan, I was talking earlier in the show about it as a way by which if you're in trouble on your loan, let's say you lost your job, there's some credit issue because, you had a bill that you just couldn't pay and you lost your job and all of a sudden you're backed up against it. I was suggesting that it's possible that your lender, if you go to them and say, hey, look, can we stretch this out to 40 years? Do you see that as a viable option, especially in a market where you might be losing your job or you might have some issue that, obviously you need help with?
Hey, Jeff, you can take a loan and stretch it 360-month term to 480 months.
Right.
Automatically will offer you a lower payment. It will provide you a lower payment option. There are also some lenders that Malibu Funding is associated with and affiliated with that will not only give you a 40-year loan, they'll give you a 40-year loan interest only.
Right.
With no penalty. In that case, allow a person to do several things. The most important, stretch out the amortization period. And for those of you who don't know, amortization just means the period of time that we are allowed to have you pay the loan off. So if it's a 30-year loan, it's 360 months. If it's a 40-year loan, it's going to be 480. And if it's a 24-month, 240. It just goes down based upon that. But it allows you to stretch that loan out. The interest-only option allows you to only pay interest and not principal and interest, which will make that payment even lower. I like those options because not only will they stretch the period out for payment, term of payment, but they also can provide an individual a lesser payment if the interest rates are higher. Now it can offset the high interest rates that we are currently facing in this volatile market.
Now, the interesting thing that you're talking about is having to do with trying to help someone out who perhaps needs help at this moment, whether they lost a job or whether they have some kind of health issue and their income has taken a hit. And the reason I ask that is because I was wondering what your thoughts are on the economy in general. I know you do loans in a lot of different states and you travel some so that you're able to see what is out there. There's the pending quote unquote recession coming. I've talked about it on the show. What are your thoughts on that?
You know what? It's hard to tell. I always tell Jeff all the time, we laugh. I'm not Nostradamus. I cannot predict the future. What I will say is that if you are trying to take a good stab at the future, you can see that all of this is cyclical, and we have seen it before.
Yep.
I believe that there's things in place that won't allow us to be in the exact same position we were when the market crashed before in 2007 and 8. But I also do believe that a market has a way of correcting itself, and it's only a period of time before it does come around. In a recession that we may know now, not being the greatest of them, but being a recession will come. The only thing I can say to you right now about the market is that the homes are not overinflated anymore. They're coming back down to where their actual value is, which is a good sign for us as far as the recession situation is concerned, because before we do understand that the market tanked when it happened last night and everything became upside down last time, and everything became upside down. Not happening right now, and definitely not happening at the pace that it did before. I do believe that people are going back to work even more so, but there's still a situation now where there are some people that just won't be able to provide or prove that they have the ability to repay. In that situation, if you see that coming on, you talk to your loan officer, you talk to your skilled professional,
right,
and help you weather the storm so that when this time does come, you won't be completely beat, but you will be actually, being able to weather the storm and put you in a situation in a position that will allow you to afford that. And even so, you also need an experienced loan officer that can help you if you're having a problem with your existing loan company, help you maybe defer some payments, help you find a way to modify your situation so that you don't take a credit hazard or credit events that may occur on your credit report. There are many things that you can do before the storm comes to help prepare yourself so that you can weather it through. And then you need a licensed loan officer to help you through that time.
Yeah, that's great advice. It really is. Now, I'm looking here at a list of home prices falling in certain cities in America. Now, we always look for opportunities because investors are always out there, and 25% of the purchases are still all cash. In these cities, Austin, Phoenix, Denver, Seattle, San Diego, San Francisco, Philadelphia, New York, and St. Louis, if you were to, throw a dart, what would be your, version of a great opportunity in a great city?
Interesting you said that. All those places that Jeff just named are places that really never have an issue with the property values, especially Texas, Florida, the New Yorks, all of those, California, those different places. I like to go places where you can get more bang for your buck. I also like to go places that will allow you to properties at a lower amount that you can then upgrade or renovate, because there's a lot of money in those particular properties. Florida is a great place to be. Texas, a wonderful place to build. St. Louis, it's funny Jeff said that. in Missouri, there's a lot of opportunity.
Yes,
now,
I
there's
agree.
There's some neighborhoods in there that obviously people have to be aware of and mindful, and those places are everywhere, USA. But at the end of the day, there are some places on the outskirts that provide you an opportunity to get into more house for less money and create a profit, a profitability in renovating these homes. Those were three of the areas, or four of the areas, Jeff, that I would definitely consider. And all the places that Jeff named, he didn't name one place that you can't get into a good transaction and make some money. And if not make money, at least hold your value.
Excellent. Great information. I really appreciate it. Listen, we're up against it. Could you let people know how they can get in touch with you? Because you obviously have, the knowledge to help them.
Jeff, absolutely. You can reach me at that good old Las Vegas number, 702-328-5191. Again, that's 702-328-5191. Or you can email me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Charles, thank you very much for coming on the show once again. Great information and appreciate it. Thank you.
Jeff, thanks for having me always.
Thank you. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, listening to us each and every week. We give you information we hope you can use. The show has been about how can we help you with the expertise that we have. We bring people onto the show to be able to do that. I personally am trying to do that in order to really receive all the information. Or if you miss something, go to the website. It's themortgagevoice.com. You can see this as well as other shows that we've done in the past. You can visit with the guests by, either emailing them or just looking at their bios. Anyway, it is themortgagevoice.com. Again, I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Okay, so expert, people we bring on the show. Kim Tran, who has been on the show several times from AM West, joins us now, which is a lender. Kim, how are you?
Oh, good. Thank you, Jeff. Thanks for having me back.
Thank you, and thanks very much for doing this. I know sometimes it gets to be hectic in our business to take 10 minutes out. I do appreciate it.
Yes, sure.
All right, let me ask you a couple of questions just quickly. Programs and rates. What kind of popularity do the programs at AM West have? Meaning, what is the most popular? And given that, when do you see that new programs coming to the market?
Yeah, actually, the market continues to shift. What we do a little bit different here, and this is our program, is that we offer quite a bit of these easy docs considered, meaning your typical won't qualify your full doc. We have a VOE, P&L to qualify instead of tax returns. We also have one for investor that without job, no income,
right?
Just qualifying with your rental income. Then we also have another one that's actually similar. It's for investment only.
Okay.
No employment, no income, no ratio, without even DSCR. We also have other products such as bank statements, 12 months of bank statements as your income. We have one also, asset qualifier, which, you have your assets and we use a certain portion to determine your income to qualify. So these are some of the fews that have been popular.
Okay, and let me just ask you straight off the bat, do you see the market improving, getting busier? Is it about the same? Where are we?
Yes, great question, Jeff, and as I'm sure you also noticed. Last year, towards the end of the year, we the whole year, throughout last year, we have this 0.78 and 0.75 rate hike a couple of times.
Yep.
And experts were predicting that, wow, this year we're going to have to wait until maybe the third quarter to see any kind of improvements. But surprisingly, over the last 2-3 weeks or so, we've already seen rates soften down.
Yeah.
If you recall last year, conventional loans were going to almost like 7%.
Yeah.
Now it's back to like 5.5, 5.6. So it's a good sign. It's recovering a little bit sooner than we expect.
Now, do you think 5.5% rate on a 30-year fixed can sustain a strong real estate market? I remember back in the day, 5.5% would have been unbelievable, but people in their head have some other number, 3.5%. So do you think 5.5% will attract buyers back to the market?
Yeah, I would say that it did attract some, and also depends on the real estate market too. Recent months I have seen, last 3 years, builders, sellers were making the calls. They're the one who's, calling the shots.
Yep.
Well, now they realize that, hey, market there's been a big shift.
Yep.
So I'm seeing a lot of builders willing to give the incentives. Also, sellers are softening the price. They're still more overbid. Also, because as lenders, many lenders are offering these temporary buy downs, where you could pay, seller pay a certain amount. Your first year, let's just say your rate's at 5.5. First year, you're paying according to 3.5. Then second year, 4.5. Third year, you go back to your note rates. So there's a lot of these tools that kind of help us out, help out consumers. And we as lender also, of course, want to keep the activities going.
Of course. Of course. Now, do you see yourself kind of right in the middle of what other lenders are doing, or what do you offer specially that maybe some others don't?
Well, for conventional loans, everyone's offering a similar thing. It's more of service and your pricing, the ease of closing a loan, right? That's for most lenders. Well, we do offer a little bit more, outside the box type of loan.
Right.
What's coming up is we plan to do a second, a standalone second.
Okay.
Also, no employment, no income, similar to DSCR. Okay? We're also rolling out the underserved market, where it's 5 to 7 units. Now, Jeff, you've been in the business a long time. You know that either you're 1 to 4 units, your residential financing, or your commercial, but most commercial lending, they're looking for the loans like 10, 20, 30, 50 units, big loans.
Yep.
So we do see that, hey, there's a certain market that's underserved. So we're rolling out these programs to kind of fill in the gap.
Well, I like the 5-unit program. I like the 6-unit program. The reason being is because a lot of unit buildings, 4-unit buildings, even a 2 or 3-unit building, want to add on or want to do a ADU, which is, of course, an additional dwelling unit. And in order to be able to do that, they need to finance it. So with a program like you're talking about, they might be able to do that.
Oh, yeah. Because for these kind of clients, when they go to commercial lending, well, they can't borrow because it's not 1 to 4 units.
Right.
When they go seek out, commercial lenders, I mean, they're not their top priority because commercial lenders, they're looking for big loan amounts.
Right. So
we always try to be innovative and try to develop programs that we see there's a market need, a niche, So we're trying. We'll continue to try, Jeff.
I know, and you've always helped in terms of those types of products with certain types of borrowers who really qualify, but they just don't qualify with every lender. So AM West has always been there really as a kind of a way by which we can say, hey, what do you think of this borrower? And more times than not, we've been able to fund the loans.
Yeah, there's always a way. And, and also just my own opinion, I always tell certain brokers are, well, they're a little bit depressed. They say, hey, the market slowed down. I said, a lot of buyers are sitting on the sideline.
Yep.
Now is the time that you need to use expertise. Consult them, explain to them. Don't be the typical buyer where rates are low, then you jump in the market, and rates are high, then you're out. You got to go a little bit opposite. So I gave them an example, and it worked out for them like this. I said, look, if they wanted low rates, they purchased the last 2 years. Property price, it's overbidding. Your property taxes, you're locked in with that high property tax.
Yep.
I mean, how long is it going to take you to recruit? Whereas now, you're buying even the higher rates. You know what they say? I learned something from a mentor before.
Right.
They said you're married to the house.
Right.
But you're dating your rate. So meaning that get the house first. You can always change with the interest rate.
I like that. I think that's also true in many aspects when it comes to financing. People are always just afraid of making the jump, and any excuse not to make the jump, like the rate's too high or the price of the house is too high. The question of, can you afford the monthly, and will that monthly adversely affect your lifestyle? If it does, obviously don't buy the loan. But if it doesn't, then you can afford it. And rates change all the time. And the way you deal with your property also changes. You may not want to take money out because there's equity in it today, but you may want to in the future, which means the rate's really not going to matter because at that time you're not going to get a 3% rate, probably get a 4 or 5% rate.
Yeah, and I couldn't agree more, Jeff. You're right on the button. I think you hit all the right buttons there. And just if you do have clients who are sitting on the sidelines, say, hey, look, if you're buying the house now, at least you're finding a property you truly want. Not when there's like pressure buying the last 2-3 years.
Yep.
You have 30 buyers competing with you.
Oh, forget it.
Contingency. Right. It wasn't a good experience, but now it's better.
Yeah, I agree with that 100%. I think the buyer experience, i.e., if you're just dealing with the seller, you can negotiate. And everybody feels good when everybody feels bad, meaning that nobody is 100% satisfied with the deal, and that's usually the best deal out there. The buyer gives a little, seller gives a little. But in the last year, it's been, last 2-3 years, because of the competition, buyers have really been, high pressured into doing things they probably wouldn't have done.
And, with the high rates, like I'm sure you heard in your area, like certain areas, my gosh, I'm hearing that you got to overbid 100, 200,000 is normal.
Ridiculous.
And I have heard some even higher. And, think about, they got a low rate when they bought that time, but they're paying 200,000 over price.
Right.
How long is it going to take them to recoup?
Right. So, all that's true.
A lot of considerations, yeah.
A lot of consideration. Listen, we're up against a time frame right now. You want to tell people how they can get in touch with you directly? Because
sure, yes. Yeah, you can contact me, cell phone. My cell phone is at 626-378-6999. You can also send me a text. Or if a better way, you can also email me, and my email address, it is kim.tran@amwestfunding.com.
Kim, thanks very much. Thanks for coming on. I really appreciate it. Thanks a lot.
Thank you so much, Jeff.
Okay. Great. That's Kim Tran from AM West. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. On an each and every week basis, we bring to you information that you're going to be able to use. It's either an opinion, or it's years of experience in the business, or it's hard facts, rates, terms, programs. All of these things are important because when you're considering purchase, you have to have a clear head and a head full of knowledge, and we can help you do all that stuff. People that come on the show are great, and they really help you understand not only the marketplace that we're in, but also the loan programs that you're trying to qualify for. There's all kinds of ways that you can do that, and with us right now, Thomas Trujillo from FlexPoint Mortgage to tell us a little bit about that. Tomas, how are you?
I'm great, Jeff. How are you today?
I'm fine, thank you. And again, thank you for coming on short notice. Thank you very much.
Absolutely.
Okay, FlexPoint. Tell us about FlexPoint. Tell us what their strengths are and a little bit about some of the programs they offer.
At FlexPoint, it's a fairly new company. Been around for about 2 years now. We are deep into FHA, DPAs, non-QM loans. We'll do seconds. We'll do first. We'll do DPAs to help you get into your property. We have Chenoa, Calhapa.
Okay.
We're getting GSFAs. So we have a whole book of business. We have seconds that we're doing now.
You know, Mountain West got out of the business, right? They closed their doors, and they were one of the, I guess, leading people in the marketplace for the Calhapa type program, down payment assistance programs. As FlexPoint just tried to come up with innovative ways by which they can tap into an I guess, helped market. These people need these programs, and the down payment assistance is an excellent way to get them into a property.
Oh, 100%. DPAs, it's a great market. It went away for a little bit because prices got crazy, but now that things are getting a little easier, rates are getting a little better. It's an awesome program. You don't want to put your money down. And why would you? You get 100% financing at a decent rate, and we have non-repayable seconds,
Okay.
so you don't even have to pay back your seconds. Why not do 100% financing?
Tell us a little bit about the qualifications for the down payment assistance programs. We have a lot of listeners who would very much be interested in these programs.
Well, I have a few of these. I have repayable seconds. I have non-repayable seconds, so you can borrow up to 105 CLTV. So you can cover your down payment. You can cover your closing costs with our seconds. If you keep the payment for 3 years, if you keep the loan for 3 years, you make the payment on the first for 3 years, and no fault. You're not late. Then we will give it. It goes away. You don't have to pay it back. That's amazing.
Amazing.
Why not take it?
Right. Why not? What are the loan limits on that?
Regular FHA. We're up to,
Okay.
I think 4 units, $1 million something.
Okay.
Absolutely.
And you lend the full on the second, the full 3.5% down payment for FHA, or is it 3%?
The full 3.5.
Wow.
So we'll give you. You can go FHA. You can go VA. You can go conventional. We'll cover the first. We'll cover the second. And if you need a little more closing costs, we can do some on the back.
That's a pretty amazing program. Do you see a lot of, obviously you do, but what are the percentages of people versus just a conventional loan that would take advantage of this in this market?
You know, you'd be surprised. It's coming along a lot more than I thought it would.
Right.
Right now, it's a hot program. That and the seconds. We have standalone seconds as well. On the DPAs, I mean, you know, if you want to hold on to your money, I have two different ones. I have CalHAPA, which has an income limit, so you can't make more than $150,000.
Okay.
Then I have Chenoa. You can make $1 million. You can own a property within the last 3 years, and we'll still give you the money.
Now, Chenoa is usually, if you own a property, you can't do this, but in this particular case, you can?
Well, CalHAPA, you can only be a first-time home buyer.
Right,
which
okay.
means you can't be on title for anything in the last 3 years. Chenoa, they don't care. So you can own a property yesterday, sell, go off and buy another property today with this DPA program.
This is really a great, we have at Malibu Funding, probably, I don't know, half the company could use these types of programs, certainly in the IE Inland Empire. And the reason being is that, the prices have really shot up over the last few years, right? Everybody knows that, 30, 40%. With a down payment assistance program, you'd be able to qualify. What is the FHA loan limit out there in the IE?
Off the top of my head, I don't remember. I think San Bernardino would be in the 500, I believe. I don't have that information in front of me, though.
Okay, fine. Because I know L.A. is, I think it's 628. I'm just guessing. But, of course, Riverside and San Bernardino counties, even some parts of Inyo and Palm Springs, all of these counties have their different loan limits. For the people out there who really don't understand what the heck we're talking about, explain a little bit about what the FHA loan is and then exactly why loan limits are different in each county.
Well, so you would have an FHA loan, which is it's a lower
interest rate.
Interest rate, yes. I'm sorry, lower interest rate. It makes it a little easier. They're a little more forgiving on the credit.
Right.
So that makes it a little easier to get to. Then when you have the DPA, if you don't have, like you said, loan limits are a lot higher. So if you don't have that 3.5% down, we will give it to you. We can give it to you where you pay it back, or we give it to you where we can forgive it. And then after that, if you're still short for closing costs, because we all know those can get up a little bit.
Yep.
We can give you 5% more on top of that to cover the closing costs.
That's amazing. The product itself is great. I love the Chenoa program, by the way. How does that actually work? I know that Chenoa is a separate deal, and your lender, over at FlexPoint, goes through them. Is that how it works? Do they just apply with you, or do they have to apply separately to them?
Oh no, we do everything. You apply with us.
Okay.
We give you the first.
Okay.
We take care of everything. We send the loan over to Chenoa afterward. They give us their blessing, and then we go ahead and fund it all. On Chenoa, you can have a lower FICO. With CalHAPA, you need a FICO at least 650 to qualify. Chenoa, you can have a 600 FICO to qualify. There's no income limit. So like I said, you can make $1 million qualify. You don't have to be a first-time home buyer, and it goes everywhere. I think we're everywhere except North Carolina and Tennessee. Everywhere else is good, whereas CalHAFA is only California.
Yes.
And then we're coming up with GSFA, which I don't know a lot about yet.
Okay.
It's a little more forgiving on your DTI, on your debt-to-income ratio.
I see. And is that also an FHA program?
There'll be FHA,
Okay.
It'll be conventional, and I believe we're going to do it VA.
I see. Okay, so all of these options with which you're bringing to the marketplace, and the company's only been around a couple of years, how are you doing? Where do you see the market heading? And is it going to be a better year than people anticipate?
I think this will be a much better year.
Right.
Fannie Mae came out and said that rate's going to drop in the first quarter to around the 4.5% rate.
Wow.
So that's going to spark us. That's really going to get us going. And I actually see a lot more action happening out there. We see a lot more purchase action. I'm getting a lot of calls. So this is the time to get in. You don't want to wait, because people waited last time, you missed out. Get in.
Now, you saw a couple banks, no, more than a couple banks, get out of the home mortgage business, whether it's Wells Fargo, whether it's Flagstar. A lot of the big banks, as well as smallers, there's been consolidations. Do you think that's good for the marketplace? And do you think they've missed the boat in terms of getting out now when right around the corner we're going to see improvement in the market?
100%.
Right.
100%. They weren't making their huge margins like they were. So now we got everyone else coming in trying to fill that gap. People have a lot more options to get into. They have a lot more freedom. It's an open market again. I think we're going to kill it this year.
That's excellent. Hey, listen, will you shout out to where people can get a hold of you? These programs you're offering are excellent, and they should get to the source. Do that, if you could, please.
Absolutely. You can always contact me through Jeff. Jeff has been a great broker with us. Jeff is a funding machine. He knows how to put deals together. You can always get me through Jeff, or you can call me direct at 323-228-5181. I'm always available 24/7.
Tomas, thanks very much for coming on the show. I really enjoy the information. Really exciting, actually, what you're doing over at FlexPoint. Thanks.
Thank you, Jeff.
Thank you very much. That's Tomas Trujillo at FlexPoint. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for listening to us each and every week, giving you information that we have on hand and as well as we've researched it. 30 years in the business, I know a little bit about what I'm talking about. I appreciate the people at KCAA, the people who also bring to you, us, on a weekly basis, Saturday and Sunday. Thank you very much. If you want to see us, we shoot this for TV too. YouTube, great place. Jeff Barton, the Mortgage Voice, go there. Great place where you can see, hear me describe to you in person, big smiley face, and I'm wearing a tremendous orange shirt today. So if you can't think of anything else to do on a Saturday, Sunday, or over the weekend, you can always come to YouTube, Jeff Barton, the Mortgage Voice. We're also on a number of different podcasts. Darryl, do we have a list of those?
We sure do, Jeff.
Thank you.
It's Apple Podcast. We've on Spotify, Spreaker, Stitcher, iHeartMedia. We're at radio.com, YouTube, and, of course, podclips.io.
Okay, podclips.io, great place where you can centralize your podcast desires. They have not only lifestyle and financial, sports, a number of other things there that you can go see, hear. It's a great place, podclips.io. Go there for your information. Again, I'm Jeff Barton. This is the Mortgage Voice. Let's get right to it. News to use in this section. 30-year fixed rate loan is 6.21%, 5.27 for the 15-year, 5.78 for the FHA, 5.70 for jumbo, and 6.27 for the 5/1 ARM. The 10-year is at 3.54, and the spread with the 2-year is about a half a point. So it's about 4.01 for the 2-year. That spread being what it is, we still see on the horizon a recession, and I think, again, Q3, that's when we're probably going to see it. How big, how slight, we don't know. but we have seen a number of people continue to lay people off in the mortgage and financial section. I'll just go through a list of first of those. Now, some of these companies have closed their retail loan mortgage origination shop. First Internet Bank closing consumer mortgage business. Flagstar shuts down retail mortgage division. Flagstar was purchased recently, as you know. Housing inventory falls. Old Republic income down 55%. Okay, so those particular things interesting. And as you can see, if somebody's income goes down 55%, Old Republic is a title company, they're obviously laying people off as well. There is, let's see, where have we got here? Okay, we're back into it. So the most important thing in the housing market, most important thing in the mortgage market is stability. Now, I've listened to a number of podcasts recently myself. I think it's a great place to go and listen to experts in the field for an extended period of time, usually about an hour. That's where the podcasting thing goes. So the most important thing in any market is to be able to predict what's happening tomorrow, next week, next month. Maybe not next year, but on a short-term basis, you want to know, okay, if I'm going to buy a house, I know that my interest rate is probably going to be between 5 and 5.5%, maybe even a narrower range, and that's going to hold probably for the next 30 to 45 days, especially when I have to lock that loan. And that locking that loan is not only always when you apply for the loan. The lock, of course, is really dependent on where the rate is that day and how comfortable you and your loan officer are about setting the expectation as to where that is. Your loan estimate will give you exactly that, an estimate as to the rate, and until you lock, it is not a lock, meaning that you have to lock in order to make sure that that's what the rate you're getting. So steady and consistent, that's what stability is. So let's talk a few numbers here. There's a 3-month, a lot of indicators look to 3 months. They don't look first quarter, second quarter. They look to November, December, January, those 3 months. And this is where these indexes and these numbers come from. Mid-November to January, mid-January 2023. What is the steady and consistent? The rates are between 6 and 6.5% on a 30-year fix. Refi apps are rising, and the purchase apps trend line is also up. These are important things to understand because you can see by this snapshot of these 3 months that we're looking at a market that is slightly improving. If you're getting purchase applications which is up, it means that the rates that are currently out there are competitive enough to draw more buyers back to the market. Now, there's not a rush to the market, and we still see sellers in many markets giving concessions, doing the 3-2-1 buy down, one portion of that, giving money back up to 9% on FHA loans. These are all things that are happening, and you won't see as a buyer as many or any at all multiple offers for the property that you're going after. So you begin to retain or get back some of the things that you were able to negotiate. Inspections, obviously. Repairs to the house, obviously. You're looking to negotiate price. You're looking to negotiate your appraisal value. All of these things are good for the market, and it's really dependent on this steady and consistent stability within those markets. Housing affordability, we went through. The active inventory is up 69% year over year. That's nationally. New listings, as we talked about, are down 5% year over year. So the overall inventory is up, but new listings, compared to January of 2022, they're down 5%. And we talked about the closing price gains, fell to 7.7% annual gain, down from 9.3%, which was just a couple of 3 months ago. Still up, but falling. D.R. Horton, net order price continued to decline by 10%. D.R. Horton, as you know, is a huge builder, and they, as I said earlier, referring to the new homes out there, yeah, they're not building as many, and they want to have even more stability in the market before they jump back in. Okay, the Fed meeting we talked about. Let's talk a little bit about income, buying homes, renting them out. we talk often, when there's a couple of people that come on the show and they talk about how their particular expertise has led them to either buy the DSCR program, which is a program where you go out, you buy a unit building or a home, and you say, okay, the rents for this will pay for the mortgage. That's called a DSCR. It's a commercial type loan. There's a little less restriction on you as a consumer with which to qualify for that particular loan. But people looking for passive income, is renting out a home after you buy it on one of these loan programs or you have something, is it really passive income? Let's talk about that just for a second. Find reliable tenants is the main problem in any rental property. I have had friends who have had nightmare tenant stories. Can't get them out. They're in there. They won't pay the rent. And you're stuck with them for whatever the law is, and a lot of times they just leave the place a mess, and it costs you way more than you had. So finding reliable tenants is the number one issue when it comes to renting out property. Obviously, collecting rent, yeah, that's pretty important. So you got to go over there, or you got to expect, or you got to have automatic deposit. However it works out, that in conjunction with finding the tenant is one of the problems. And of course, you have to handle the repairs. The repairs are out-of-pocket expenses and unknown. There is normal wear and tear on every property, every car, everything. I mean, the weather in general, especially this year since we've had a ton of rain, is really going to make either the roof or the sidewalk or the driveway. There's a lot of repairs that need to have happen, and in emergency situations, you're the landlord, you're out of pocket for it. So does any of that sound like passive income? No, you're active, you're involved. Now you can hire a maintenance company, but you still need to get involved. You got to give them permission to fix stuff. You got to give them direction on what to do. So all of these things combined, yeah. So what about a thing like a REIT? Now a lot of REITs are available out there. You buy a share in a REIT. We talked a couple months ago, probably more like 3-4 months ago, Jeff Bezos in Arrived Homes. He's one of the chief investors in Arrived Home. Now, Arrived Home is buying a REIT-like investment in smaller investment projects, and the return on these are pretty good. For an example, one was you buy a property, but your money is invested in that property. The rents give you a certain amount back every month, plus the value of your shares go up. And that's exactly what happened. If you had bought one of these with Bezos a year ago, the investment at $10 a share, now worth $20.79. And there's a dividend of 7.5%. Pretty good, right? Absolutely. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Southern California's Mind Spring. Progressive talk in Southern